that was what he wanted.
Yeah.
I'm not sure it always worked.
Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Greg Carpenter. Greg is the Managing Director for BTI Group M&A, Mergers and Acquisitions, a business brokerage firm located in Campbell, California. He's been a business sale intermediary since 1985. The current focus of his business is on the middle market, valued from about $5 million to $50 million. He was on the board of directors for the California Association of Business Brokers for 9 years. Greg is a frequent speaker on about how to sell a business, and he's also an arbitrator for the California State Bar and the Santa Clara County Bar Association. Greg says he has a great home in Incline Village at Lake Tahoe. He doesn't get to use very much, and so you'll see his contact information at the end of the show. Might be willing to talk to you if you're looking for a place to stay. So with that, today we're going to talk about preparing to sell a business. We're just going to hit some highlights. This is intended as the beginning of a continuing conversation with your business broker or advisor. So Greg, thanks for joining me today.
Well, thanks so much for having me.
Okay. Today is September 17th, 2013. Greg, could you tell us a little bit about what is the market like today if you're going to sell business? Is this a good time to sell a business? Is this a better time in the market? We've just gone through some tough years, or is this a worse time, or about the same? What's going on?
Big picture is it's a pretty good time to sell a business. If you look back over the last 5 years, we've gone down into the depths of the Great Recession, and most businesses have climbed most of the way out of it, if not all the way out. Some are still lagging. In the middle of that recession, there was no opportunity for bank financing to buy a business. And now things are pretty much back to normal. Maybe the bank underwriting standards are a little tighter than they were, but they're reasonable. So a buyer that has some related experience and a reasonable balance sheet, buying a healthy business, can get financing.
Good. All right, well, let's get into some of these issues related to selling. So what are some ways that buyers and sellers use to determine a value or a sales price for a business?
They go all the way from the corporate approach, where you'd hire a third-party credentialed appraiser, down to the hip shooter approach, where the buyer reasons, well, he's asking X for it, so I'll offer him 0.8 of X, which is not very scientific at all. And usually the truth lies somewhere in between.
Okay.
People look for comparable sale data and compare price to earnings ratios, price to sales ratios. They look at the assets of the business. Look at the trend of the sales. Is it trending up? Is it trending down? Is it steady? How profitable is it versus its peers in the industry? And is the seller a unique individual who has relationships with all the customers and vendors such that when he's gone, the business is likely to fall apart? Or is it such that it's a real business where the customers and vendors probably don't even know who the owner is, and it'll go on just fine without him? So there's a lot of moving parts in a business, and many of them relate to the valuation. Some of them would also relate to the terms of the sale. For example, if a large percentage of sales are to one customer, or if a large percentage of everything being sold comes from one vendor, then going forward, the new owner had better make sure he maintains those relationships, because if he loses them, much of the value of the business is going to go away. So perhaps part of the terms in that situation might depend on a contingent payment for keeping those relationships going in the future.
Okay. What important assets and liabilities typically are not on a company's financial statements?
Well, this is a tricky one. This is probably one that you're better qualified to answer than I. Usually we see most businesses sold in the form of what we call an asset sale, as opposed to a sale of corporate stock. And that means that if it's a corporation or an LLC, it is that entity, which is a separate entity from the shareholders, owns the assets of the business, and it is selling those assets. And the typical convention for structuring the sale is to exclude cash and often receivables, and also all the liabilities of the business are excluded, so that the buyer can use third-party financing and they can put a lien on those assets as collateral. Off-balance sheet types of financing might be operating leases for equipment that the business actually doesn't own, but it just rents. Certainly, goodwill doesn't show up on anybody's balance sheet unless they bought the business. You probably have some ideas on that too. Let's hear yours.
Well, I think the number one thing really is, in a sense you talked about it before, is the relationships. And in a sense, it's the customer. It is the list, if you will, of the customers. And so there are some business owners that are very conscientious about knowing who they're doing business with. Of course, that's usually where you'd be getting orders coming in, and so you can maybe go through and have some sort of a list that's available. Others may not. You know, like if you have a 7-Eleven store, then they may not have a clue of who's coming through there. They haven't bothered to capture the names. But you know, even with a hardware store or other types of retail businesses, a dress shop, it's good to know who your customers are, and as you're operating the business, that should be a real key thing, is to capture that information when people come into your
Well, certainly in
shop.
the age of digital marketing, that's essential,
Yeah,
because
yeah.
you have to have a way to communicate with these people. You have to keep reaching out to make contact with them frequently, or they forget you.
That's right. In fact, we say, they used to say some time ago, you want to contact people at least quarterly. Now we say you should really be contacting people at least monthly. And there are some people, I have one guy that I get 3 emails a day from this guy. It seems a little excessive, but he says, as long as people don't complain too much and they keep buying from me, I'm going to keep doing it. So,
Well, if it works.
yeah. So, okay. So you've been operating some business for some time, your business for some time. I'm just throwing out, the thought process here. Should you be operating it differently when you're getting ready to sell it? And if so, how should you be doing that?
Definitely, you should tune your business up and prepare it for sale. The value of the business is worth a function of the documented business performance. One area where most business owners fall down and really lose value is in keeping very good quality books and records. When a buyer comes in to buy a business, he wants to verify the business performance. He's going to bring in an accountant, someone such as yourself, who's going to try to tie the summary level statements, such as tax returns, profit or loss statements, and balance sheets, all the way down through to the transaction level, bank statements, merchant accounts, cash transactions, all those sorts of things. And if a business is doing what we call shoebox accounting, where they just keep their statements and their receipts and things all in a big shoebox, and at the end of the year they give it to their accountant to do the tax return, they're going to have a very difficult time getting through the due diligence process and proving their business performance to a buyer. And it's going to hurt their value. And in fact, it may cause a lot of wasted time on behalf of the seller, the buyer, and the broker, and the accountants, because you may have 2 or 3 deals in a row that fail because they can't prove the business performance. So it adds great value to have really good books and records. At the very minimum, a small business should be using QuickBooks. As businesses get larger, they should migrate to Peachtree or Great Plains or another one of the more professional software packages for larger business accounting that'll give a lot of detail and various sorts of reporting capability. Another thing to watch is the trend of sales. 2 businesses may have had the same exact sales and profits for last year, but if one of them trended up to that number and the other one trended down to that number, the one trending down isn't going to be worth as much, because in the end, valuations of businesses are based on expectations of future earnings. So there'll be a downtrend discount because they'll know in the future it's likely to be doing less. And likewise, you can get a growth premium if you're on a track to show steady growth. In fact, SBA loans today follow the Small Business Administration's standard operating procedure. And if lenders don't follow this procedure, then the SBA guarantee is no good. Well, one of the conditions and requirements of that standard operating procedure is the business cannot have downtrended 2 out of the last 3 years. They won't guarantee the loan if it did. So, very important, even though you may mentally be already on the beach in Hawaii in a nice canvas chair with a little straw hat and a pink drink with an umbrella sticking out of it, you have got to keep that business performing and hopefully trending up right up through closing of the sale. You can't go to sleep at the wheel here.
Okay. So related to what you're just talking about, trying to get in that upward trend, how can a business owner manage his business to build value and marketability when he's preparing to sell it?
Well, the business owner has to be free to commit his time to work on the business and keep it on track. That's where using a professional broker to help you sell the business lets you as the owner focus on keeping the business going and on track and advising you about the things you need to do to get it in order. Just like when you're selling a house, you want people to be impressed when they come see your business. They're not necessarily going to be impressed because you have really nice furniture in your lobby, but they will be impressed if your production area is neat and tidy, if you have proper documentation for all the materials going through, and there aren't stacks of material just randomly stashed here and there unaccounted for, if your inventory records are accurate, if you've done the marketing job, if you actually have a marketing initiative and a marketing system, if you've got inventory controls such that your inventory records are accurate. If it says you've got 500 of these, you go and guess what? You've really got 500. Hey, that's great. All these things are things you need to pay attention to while your broker is doing the work of selling the business. And if you're trying to do both, it's going to be pretty hard to do a good job at either one.
Here's one. Let me throw this out to you. Is your restroom clean? Do you have a soap dish with a 3-month-old bar of soap floating in it? I mean, it's paying attention to some of these little details, and really that you should be doing all the time anyway when you're running a business well. But you want to pay close attention to those details when you're presenting. Like you said, you want to present yourself the best way that you can. I think I can't remember, I think it's like Broken Windows, Broken Businesses, or something like there's a book.
I think the bottom line is if your business looks professional because everything's in good repair, everything is relatively new, things are clean and organized and neat, the buyers are going to get the impression that this is a professionally run, good quality business. And if things are in disorder and disrepair and old and dirty and ripped and torn, they're going to think this is probably not a very good business.
Okay. So what are good candidates for suitors to purchase a business?
Well, obviously it depends on the business. And part of the broker's job is to match the right buyer with the right business. And in fact, even though we have several hundred businesses for sale at any time, when a buyer calls in about a particular one from one of our ads, we don't necessarily even show him that business. First, we interview him and we understand his situation, his profile, his experiences, capabilities, resources, interests, and then out of our inventory of businesses for sale, we show him the businesses that fit him. And you can't get financing for a business where the buyer is a complete mismatch, if you're looking for an SBA loan. They found in the Great Recession, the biggest reason for failure in small business sales, where the loans had to be foreclosed, was lack of experience in that industry, or at least a transferable skill set of the buyer. So now that's one of the requirements. You could have
an engineer who decides to come and buy a fast food franchise and doesn't have a clue.
For example, well, that might actually work, but the engineer is a good example because some engineers, not all, but some have spent their entire career sitting at a computer monitor doing CAD/CAM work, rarely talking to anybody unless they go to a meeting there where they're mostly listening. If you put them into a business where the essential skill the owner needs to have is marketing and sales, probably he's not going to do very well. because his solution to everything is going to be sit at your computer and do something on the screen. That's not going to work in marketing and sales. You need to reach out and touch people, and you need to motivate people to come and look at your business and look at your offerings of products and services and buy them. And unless you've got deep experience in that, and unless you have a lot of people skills, which you probably don't have if you spent the last 10 years staring at a computer screen and not talking to anybody, you're not going to do very well with that. So we look for people that have deep marketing and sales experience to fit into a business where the owner's key function is marketing and sales. So that's the sort of transferable skill I'm talking about. You don't necessarily have had to work in that industry, but you have to have those skills.
Okay. Well, if you're thinking about selling a business, what sort of communication should you have for your employees?
Depends on your relationship with the employees and depends on the nature of the business. The industry standard is strict confidentiality. Only key employees will have any clue that you're thinking about selling. And those key employees would certainly be your controller or CFO, because let's face it, you've got to produce all sorts of financial records to get through due diligence. How are you going to do that if they don't know?
Right.
You can't.
Right.
It might be a key manager or a key sales manager or somebody like that, but generally it's only the financial management person and the owner who know until the very end. And at the end, after the close of the escrow, the new owner introduces, or the old owner introduces the new owner to the employees, who immediately assures everybody there'll be no changes. You're all hired. You're at the same compensation. You've got the same opportunities you had before, only better, because I'm going to invest more money in this company and make it grow. So we're going to need to hire some more people, and that'll create promotion opportunities for you guys, et cetera, et cetera. The reason for the confidentiality, reasons I should say, number one, employees don't really understand about selling businesses. And there is a misconception in the general public that when a new owner takes over, the first thing he's going to do is get rid of all the employees and bring his own in. That's the farthest thing from the truth. Employees have a lot of what we call tribal knowledge. In other words, everything in a business that's required to run it isn't written down somewhere. People know what to do because they've been doing that job for years. That's really not written down. They know what customer X really wants and how he wants it. They make sure customer X is happy. You get rid of them, the next person's going to blunder and not know. Also, competitors may use the fact that your business is for sale to sell against you. So if you're in a retail business of big ticket items, something very competitive like tires, they may say, well, don't buy tires over there because he's selling the business and the new owner probably won't make good on your guarantees on your tires. So you don't want the competitors to know for sure. Also, the competitors may go tell your employees and then they'll quit because they're scared. They think, oh my God, when someone comes in, they're going to fire us all, so I better go get a job now, and they'll quit. We had a situation in a manufacturing company where, unfortunately, the buyer's attorney faxed a document to the shipping department of the company they were buying, and the guy picked it up off the fax and walked around and said, hey, everybody, did you know they're selling the company? And 40% of their employees quit in the next 2 weeks.
Oh my gosh.
Yeah, so you really have to be careful about that.
Wow. Should I hire a business broker to help sell my business?
Well, since I'm a business broker, of course.
Maybe you talk about advantages and disadvantages. Whatever.
Yeah. I would say that the reasons you would want to consider hiring a business broker are, first, we're going to help you prepare your business for sale so that you'll have added value. Second, we're going to make sure that everything is in order so that you can get through that selling process and that due diligence process without losing the buyer. Third, we're going to maintain the confidentiality of that sale right up until the end as tightly as it can be maintained and protect your business from harm from the word getting out about the sale. Fourth, we're going to help you with the negotiations. And selling a business isn't something every business owner does every day, but it is something we do every day. And for example, I have been selling businesses since 1985, and I stopped counting at 350 transactions.
Mhm.
And if I close 350 transactions, that means there's probably another 400 or 500 that at least I had offers on.
Mhm.
And so I've had a whole lot of experience in negotiating and seeing how people react and knowing what works and doesn't work, knowing what's reasonable, not reasonable. I can help advise the seller and the buyer about how to make it work and suggest alternatives that'll work for both parties. We'll help you get through escrow if there are any issues that come up. We do a lot of problem solving in our business. Meanwhile, Mr. Business Owner, you can be still making sure your business is on track and making money and staying level or growing instead of being distracted with all these issues that we're working on your behalf. So in the end, we add a lot of value for a lot of business owners, and we make it possible to sell sometimes when it couldn't otherwise be sold. For example, look at anybody's tax return. It probably says they're not making any money. Well, we know that the business really is making money, but you have to understand how to recast those financials to show what the business is earning. Most business owners don't know how to do that. That's one of our value adds.
Okay. What could I expect to pay a broker for doing this type of stuff?
Depends on the size of the business. If it's a very small business, you will find that some brokers have programs, as our company does, where we help you prepare and package the business for sale, and then we turn it over for you for a small fee, a few $1,000s. If it's a little bit bigger, then our minimum fee of $15,000 versus a 12% of the selling price is a reasonable fee for you. You can afford it and it'll benefit you. We'll add more than that in value usually. As businesses get larger, say closer to $1 million, then our fee can be 10%. If it's in the several millions of dollars, we use what is called a double layman formula. So that's 10% of the first million plus 8% of the second million, 6% of the third million, 4% of the fourth, and so on.
Sort of a sliding scale.
That's right.
Yeah. Let's say I sell my business. Do I have continuing exposure related to business liabilities after selling that business?
Maybe. It depends. If you're a corporation, if you own a corporation and you're the shareholder, and the corporation sells its assets, usually part of the agreement, the purchase agreement, is that you're required to pay off all of that corporation's liabilities. And that means filing your final tax return after the sale and paying whatever taxes are owed on the sale as well as the earnings of year to date up to the closing date. So if you sell the stock of your corporation and the buyer actually takes over your corporation, your representations and warranties obligate you to defend the buyer, hold harmless, and indemnify him against obligations and liabilities that might arise from the period in time where you owned that corporation. So you probably don't know of any liabilities like that, but it's possible one could arise. For example, the IRS might come and audit you for the years prior to the sale. Now the buyer owns the corporation. So the IRS is going to be talking to the buyer about that. Mm-hmm. But if they say, well, you owe X dollars, guess what? They're going to come back to you, Mr. Seller, and say, you have to indemnify me from this IRS audit and the fees and taxes and penalties and interest that are due because you didn't file your tax returns properly before. It could be that an employee submits a claim for a work injury that hadn't been reported before. Maybe they just didn't tell you and they've been limping around with a bad back for a month, and then they finally go to a chiropractor, and guess what? They submit a workers' comp claim. You're going to be accountable for that. So yes, you may have liabilities after.
What are some different ways that you can put sales together? I think you sort of hit a little bit on it in your last response, so maybe you can sort of go over that territory a little bit.
Do you mean how do we find buyers and sell the business?
No, I think more of structures about buying assets, selling stock.
Okay. The two basic structures are to buy the assets or buy the stock. Now, businesses can be held in ownership as a sole proprietorship, a partnership, corporation, or limited liability company. In the case of the sole proprietor or a partnership, the only possible sale is an asset sale. In the case of a corporation or a limited liability company, the buyer can buy the assets from the corporation or limited liability company, and that we would call an asset sale. Or they could buy the shares of stock of the entity from the shareholder. That would be the individual that owns the shares. Mm-hmm. So the major difference is probably you would have advice for your clients about whether they should choose a stock or asset sale. Would you like to talk about that?
I think actually we don't have time to go into the details. So
Okay.
folks, I guess I'll say this really is an area that you need to see your tax advisor and to go over the details. But it can make the difference between whether your tax is going to be a capital gain, whether you're going to have, for example, ordinary income from depreciation recapture or something else. And also you could have a covenant not to compete as part of your deal. That's going to be ordinary income. So anyway, so you really need to get advice about this.
All good points.
Okay, so time has flown. We only have maybe a minute and a half left. Maybe you can just throw out a final thought.
Well, if I were a seller and I wanted to sell my business, I would think of it as a 2 to 3 year process. And I would get some help in the very beginning to analyze my business and focus on the key points where I can get the most return for any effort or investment I might make in terms of growing the value of the business. After all, what is an entrepreneur's function? It's to create value. Mm-hmm. And you can create value very quickly and efficiently, or you can just kind of lumber along and not really create any. So get some help. Do the things that will grow the value in your business the most, which would be growing sales and profits and increasing the quality of your business records especially. That can help you get and close a sale very quickly, whereas if you have relatively poor or sketchy records, buyers might not even be able to get financing. You can have deals that drag on for months and cause everybody grief. I can't tell you too much that you really need somebody like Mike Gray to get your books and records in order, and that'll make your life easier, my life easier, and the buyer's life easier.
Okay. Greg, thanks a lot for being with me
Mike.
today. It's a pleasure. Folks, I hope I've given you some things to think about, and I guess I'll just say, as I usually do, we'll see you next time on Financial Insider Weekly.